Good afternoon, everyone. Hello, friends, and thank you for taking time. We're going to get going with our presentation. As most of you know, this is getting recorded, and just want to let you know that everybody is muted. So what we'll be doing is at the very bottom, part of this and why we do this live is to allow people a chance to be able to ask questions. So we're going to answer all the questions at the end of the presentation. Robert Maxtroth, who is one of the portfolio managers for City National Rockdale, is going to be doing about a 30-minute presentation. I'm just going to let him share his views and some of the slides and materials they use when they're talking about what's been happening as far as past data, and then as also what they see moving forward. So we are going to see at the very bottom of your screen, you should see a Q&A. You're welcome to click on that and ask any questions. And we are going to save all the questions till the very end. We typically get a few repeats, which is totally fine. We're going to do our best to answer all the questions. And if we can't get to the questions, we will follow up via an email with you or a phone call afterwards. We do want to make sure you do get all your questions answered. So with that, I'm going to let Robert go ahead and get started, and we're going to cover, I know you have a lot to cover with inflation, taxes, kind of what's going on with the economy. So see how much you can get done in about a half hour. How's that sound?
Sounds good, Chad. Thanks so much for the intro. And thanks to everyone who is joining live and listening to the replay. I really appreciate taking time out of your day to listen to me give you an update on what's going on. Sometimes you do these updates and there's kind of one or two main themes and main things going on in the economy. This is one of those times when there are quite a few things going on. So we don't have a shortage of things to talk about. So like Chad said, if you do have any questions, just click on that Q&A button. You can ask with your name attached to it or ask anonymously if you want. But without further ado, let me dive into the presentation here. And I'm going to kind of just show you a couple of the high level things that are going on, and then we'll dive in a little deeper with some of the data. First off, vaccine driven return to normalcy. This is a huge one. I'd imagine most are noticing this now that people are out and about, restaurants, bars, hotels, airlines. We're seeing at the pandemic level, we haven't seen this type of activity in a long time, and that's huge for our economy. We'll dive into that. Strong consumer recovery. I mean, this is huge. If you've heard me talk about the consumer being 70% of our economy. So if the consumer is strong, many times our economy is strong, and the consumer is certainly strong right now. Job growth. This is a very interesting one. This is actually one of the economic indicators that's recovering the slowest. So we'll dive into our outlook for job growth, why we don't think it's an issue in the economy right now, and what we're likely to see over the next couple of months and even the next couple of years. Chad alluded to it, but inflation is the number one question. In 9 out of 10 of my meetings with clients right now, inflation is the first question that comes up. Got 2 slides on inflation. It's important discussion to have, so stay tuned for that one. Fed policy. This is another important one. It often doesn't get talked about in the main headlines, but monetary policy likely to remain accommodative through 2021. Big implications there. Same thing goes with fiscal spending. The government is certainly not holding back about continuing to spend money. We'll talk about the implications of that, both positive and negative, associated with the levels of government spending we've already seen and what we might project to see through the rest of the year if some of the new proposals do go through. S&P 500 earnings. This is a big one. When you look at the earnings of companies out there, they're at record levels. Companies are making money at record rates, even above where they were before the pandemic. And when it comes to stock prices, that's the best predictor of stock prices, is the profitability of companies. US and emerging Asia, 2 areas we think are the best positioned over the next 5 and 10 years. Europe likely to lag. We don't like Europe at all. A lot of reasons for that, which we'll go into a little bit, but our main focus is on the US. with a little bit of emerging Asia sprinkled in as far as investment opportunities go. Valuations. Valuations of the stock market is one of the cautionary signals out there. Stocks aren't cheap. How do you invest in a world with a good economic outlook, but an expensive stock market? I'll tell you what we're doing in this exact situation. Large, small and mid-cap companies, economically sensitive companies. These can be an opportunity in an economic environment like we'll talk about. Very positive, early stage of a nice recovery can benefit small and medium-sized companies. Conservative fixed income. This could be the most challenging environment we've ever seen for the safest assets. I'll talk about why that is. That's where a lot of the connection with inflation goes. Cash in the bank, still paying 0. Traditional treasury and government bonds, you're lucky to see even close to 2% some of those. So again, how do you invest at a time when stocks are expensive, but bonds don't look very attractive? Stay tuned for more on that. So those are some of the topics we're going to go into today. I'm going to start with the pandemic because this is big. Almost all of our behavior was affected, or not necessarily everybody, but a good portion of the country, behavior, consumption patterns, everything has been affected by this pandemic, and the vaccines are working. So this chart shows the daily rate of people receiving the first vaccine dose in the U.S. You can see that surge. At times, we were even up to 2 million people a day in the U.S. getting that first shot. And where 50% of the U.S. population has at least received one shot, and now 50% of adults are fully vaccinated against COVID. So you take that 50% of adults fully vaccinated, you take another portion of the population that may not have been vaccinated but have already been infected, and we may not know exactly what that number is, but getting closer and closer to that herd immunity level. And it certainly doesn't hurt that the vaccine just got approved those 12 to 15 years old. We're going to see that already starting to make a difference with vaccine deployment. So this is where we see the data supporting that the vaccines are working, because I'll talk about it in the next couple of slides. We are out and about. Schools are reopening. We're getting back on planes. We're going back to bars and restaurants. If anyone watched Phil Mickelson win the PGA Championship on Sunday, you saw the crowds that were out there in South Carolina. I mean, you had massive crowds at the golf tournament. You see the NBA playoffs now taking part with fans in the stadium. And at the same time, you see COVID cases, hospitalizations, and deaths at the lowest level we've seen in months. You got to go back to way at the early stage of the pandemic when even testing was at much lower rates to find case levels that we're seeing now. That's huge. It means that all of this activity is not resulting in another huge surge in cases, hospitalizations, and fatalities, and means we can continue to start using the economy. And this might be my favorite slide, just showing how out and about we are right now. So this looks at where we were before the pandemic on the left side of the page. That's where it's indexed to. And it looks at 4 different categories. So you'll see restaurants and TSA air traffic. So restaurants are open table reservations, and the TSA data is how many people are going through security every day. See, both of those, we haven't seen a level this high since the pandemic started. So we're not all the way back to where we were before, but we're closing in. And I wouldn't be surprised that we get there in terms of restaurants by the end of the year, maybe even above where we were before. And why is that? Pent-up demand to get back and do the things we like to do. I mean, look at this other data point, mobility. What is this data coming from? It's actually coming from Apple. Apple has data on mobility from GPS in everyone's phone. They know how out and about we are based on where our phone location continues to change. And you see, we might not all be going back to restaurants and airlines yet, but we're clearly leaving the house because mobility is at a higher level than we've seen even before the pandemic. And you can see it outside. I mean, people are out kind of across the country, even in some of the most restricted places in the middle of the pandemic, like here in the San Francisco Bay Area. You see restaurants packed. You see activity picking up, even in a place like this. So great to see. And most importantly, out of all of this, spending has been very strong. Look at credit and debit card spending. It's actually higher, starting early in January. It's higher this entire year than it was before the pandemic. And that's huge. It means people are spending money. And now people are starting to spend money on more services activities, like you see in restaurants and bars. So all good news on the COVID front. We're heading in the right direction. And for many of you who've heard me give these webinars before, you've seen this slide time and time again. Our 20 economic 20 economic indicators for where we think the U.S. economy is going over the next 6 to 9 months. And this is the most positive report I've seen as far as the economy goes, outlook for the economy in the 11 years I've been at City National Rockdale. It's just such a strong outlook for a lot of the reasons we talked about. We had the situation where the economy went to a halt in the pandemic, and now we've got the green light to get very close to back to normal, and people have this pent-up demand to spend money. So do people have the ability to spend money? We talk about the demand to spend money. Look at the top two indicators here: consumer confidence and disposable income. Consumer confidence has never been this high, or it hasn't been this high since the pandemic started. And a lot of that's to do with disposable income being good. Combination of feeling good about getting back to normal, and we have a lot of money to spend. And that sounds a little counterintuitive. Do we really have a lot of money to spend coming out of a pandemic like this, a recession? The answer is we do, not only with disposable income, but asset values being high. I'll go through some data in a second, but the housing market is as strong as we've ever seen it. I mean, you got double-digit housing price growth in almost every major market across the country. This is at a time when there's a very low inventory of homes. So this is probably not necessarily going to crash or slow down anytime soon. You have low inventory and high home prices and high demand. And then stock portfolios, retirement accounts are back to all-time highs for many people that stayed invested through the pandemic. So when you look at household net worth, we have a record amount of net worth in this country right now because home prices are at records, stock portfolios are at records, and the savings rate in this country has been double digits over the last year. And we are not a savings-based economy. Americans notoriously are spenders. We have traditionally had very low savings rates. So having double-digit savings rates is a temporary thing because of this pandemic. People just couldn't spend some of the money that they normally would. So that savings is going to turn into future consumer spending. And that's huge because 70% of our economy is consumer spending. So we talked about asset values, we talked about savings rates and disposable income, but there's a portion of the country that may have been adversely affected by COVID more than others. People are out of work, people who aren't homeowners and aren't asset owners, that aren't those gains. Well, the fiscal policy arm of the government has kicked in multiple stimulus packages, including another $2 trillion earlier this year, that has certainly gone to increase spending when it comes to even lower income individuals that might not have been experiencing some of those asset valuation gains. So, one of the most important questions that we get is, well, is this government spending too much? What are the negative impacts of this fiscal policy? And when you look at the Fed keeping interest rates low, that concerns people. Are we spending too much money? Did we go overboard on the stimulus and the unemployment benefits? The answer is we probably did go a little too overboard. We kind of, instead of targeting policies that were more tactical, going exactly to the people who needed the money, we did the more broad coverage where 80% of the country got a stimulus check. So what is the effect of that? If you might have gone a little too high on the spending, well, the effect of that may be counterintuitive to some people because, when you think of it, some people that I've spoken with have talked about, government spending being too high. We need to, reduce our exposure to assets, reduce our exposure to stocks. But what is the effect of government spending on consumer spending? You give people more money to spend, what's going to happen to the profitability of Amazon and Costco and Walmart and Home Depot and TJ Maxx and home and Starbucks and all the companies where Americans spend money, their prospects certainly aren't going to go down. And this has been a big theme in how we position portfolios, is that if the government's going to shore up municipalities, if the government's going to spend a lot of money, they're going to give unemployment benefits to people, well, that money is going to get put back into the economy. So the consumer spending effect is going to be positive. And now many people are going to the inflation question. Well, is this going to start to lead to higher inflation? Are there going to be negative consequences of this spending? When is that going to show up? And I'll dive into that in a minute, because you do see there are some risks out there. Stock market valuations have gone up. Stocks don't look super cheap. The political environment is certainly not great right now. You have proposals on the table that are one-sided. It's all the Democratic Party. You're not getting bipartisan agreements. I'll talk before we end the call on the potential effect of some of the tax policy that the Biden administration has proposed. So we've done a ton of research on that, and we do think there are some risks associated with tax policy, but not necessarily risks that are going to derail the economy or the market. And that's important. And I'll touch on that a little bit before we wrap up there. But all in all, a very positive view of the economy going forward, and you see it in the numbers here. So 2021, we see the U.S. economy growing anywhere from 5.5% to 7%. And this is a higher level than we were projecting last time we did one of these calls. I mean, you saw it already in the first quarter. We've grown 6.5% as an economy. A lot of this is getting back what we lost in the pandemic, but the growth rate is strong. This is a faster recovery rate than what we saw out of the great financial crisis last time around. And to put this in perspective, this is the economy growing, call it 3 times the average rate of economic growth before the pandemic. And this is likely to continue into 2022. So we think the risk of the U.S. economy decelerating and going back into a recession is extremely low over the next 2 years. Your risk of the economy overheating is stronger than the economy going the other direction. And again, we'll talk about that in a little bit. But when we dive into the data here, look at corporate profit growth at the bottom. This is what I'm talking about when I said company earnings are bouncing back fast. 27 to 33% growth in corporate earnings in the first quarter, or not in the first quarter, estimated for this year. That's a huge number. You can see corporate earnings only declined by 14% last year. So companies held up rather well during the pandemic, and now are seeing profitability surging, not only for this year, but even into 2022. So you'll notice 2022, we still have corporate profit growth at 10 to 20%. And I often get the question, well, isn't the Biden administration going to reverse the Trump tax cuts and tax companies at a much higher rate in 2022? And that's a good discussion on one part of that tax proposal, corporate profit taxes. I think that has the biggest potential to derail things. And fortunately, there is absolutely zero chance of a full reversal of the Trump tax cuts. It's not in the cards. The Democrats have such a slim majority in the Senate that the moderate members of the Senate are not going to possibly do that. What they're likely to do, and you see, Senator Joe Manchin out of West Virginia is the main guy on the opposition for some of the policy changes, is saying, hey, do we need to increase corporate profit taxes at all? So at the end of the day, we're pricing in a corporate tax increase that is more like a 3 to 5% corporate tax increase. So instead of maybe 15 to 20% or 15 to 25% corporate profit growth next year, we bring it down to 10 to 20 because of a small increase in corporate taxes. A full reversal would be much more detrimental, but that's where it's important to really research what is actually going to be the final approved plan as opposed to the proposals. If you react to the proposals, you have a potential to make a big mistake and miss out on some nice gains. I think a lot of people, there are questions from clients ahead of the election. Well, hey, I think the Democrats might have a chance to win the election, have control, so I need to get out of the markets. I need to reduce risk for that scenario. But you see what happened. The Democrats did gain control, But a lot of the policies ended up, if you disagree with them, if you agree with them, the effect of those policies have been increasing expected consumer spending because you're putting more money out there. Increasing corporate profitabilities. Again, increasing government spending helps companies make more money. Again, there could be some downsides to this, which we'll talk about, but the immediate effect has been, not only a strong economy, but, booming corporate profit growth and good stock price performance. So those are some of the forecasted data we have here. Last thing I'll mention, and then we'll dive into some of the detailed data here. Federal funds rate, the rate the Fed is setting on short-term interest rates, we have that near zero into 2022. The Fed is likely to keep interest rates low until the employment situation recovers. And the Fed is saying the inflation we're seeing right now, a lot of it is temporary. We do not need to react to it. And we agree 100% with the Fed's actions there. We see a lot of the temporary inflation not derailing the economy in the short term. So keeping interest rates low helps keep this economy going, because you raise interest rates, you're going to see negative effects if you raise interest rates, specifically in the housing market and many other markets. So the Fed is going to be very, very cautious about that first rate increase. And we don't think it's coming until late 2020, if not early 2023. So this is some of the very interesting data behind the scenes here. Look at retail sales. Retail sales are at the highest level we've ever seen. And look at that jump. The big drop in the pandemic, the full recovery, and now we're spending more money than ever before. You can see strongest economic growth outlook in 40 years. A lot of that's fueled by the consumer. But look at manufacturing. This one is fascinating. This is ISM manufacturing. The blue line here is right at 50. This is called a diffusion index. So anything above 50 indicates expansion. Anything below indicates contraction. U.S. manufacturing is expanding at the fastest rate we've seen since the early 1980s. And you may have seen a lot of the supply shortages that are out there. We have a shortage of cars. We have a shortage of furniture. We have a shortage of exercise equipment. We have a shortage of hot tubs. I mean, from where we were in the pandemic when it first started a year ago, who would have thought that we'd be having a hot tub shortage crisis just 12 months later? And that would be something that is holding back the economy. And it's true, you just see it. I mean, the demand has picked up so quickly for things, and the supply just can't keep up. And same thing goes with homes. Look at building permits. Construction is picking up at such a fast rate that the price of lumber has spiked. That's an example of a transitory or temporary inflation effect. Eventually, the building will catch up, and eventually lumber prices will normalize. So same thing goes with manufacturing. We're not going to be paying a premium for hot tubs 24 months from now. That might continue another 12 months. I keep going back to the hot tub analogy because I'm just so fascinated by that one. That's such a discretionary luxury purchase, like you can't get one. But that's the economy we're living in right now. And, look at this. I mean, household net worth, I talked about it. It's record high levels. What a jump in household net worth. What a jump in home prices. What a jump in retail sales. And then auto sales. I mean, when this pandemic hit, take yourself back to late March of 2020 or early April. No one was thinking, oh, this pandemic's just going to end and demand is going to pick back up and we're going to be looking at record high auto sales and home prices. Everyone was time where we should be patient and wait to buy things. And same thing goes with companies. They said, hey, if you're GM, if you're Ford, you cut production in the pandemic because of safety precautions. And then is also you're forecasting a lower demand for cars, thinking it's a recession coming. And just no one expected auto sales to bounce back this quickly. And, not only have they bounced back this quickly, but rental car companies shed a bunch of their fleet at the start of the pandemic. And you have this surge in travel demand at a time when there's no available rental cars. And it's this just absolutely disaster scenario for these rental car companies that were on the brink of bankruptcy, now have this unprecedented demand for their products and don't have enough cars to give to people. I mean, another data point about how people are back, arrivals on Maui right now are higher than they were before the pandemic. If any one of you have been on the call, or any one of you on the call has been to Maui recently, you may have seen this. There's no restaurant reservations available. Everything's booked. There's no excursions available. Everything's booked. There's no rental cars available. People are driving around in U-Hauls because that's the only vehicle available to rent in Hawaii. So these are just unprecedented times when there's no rental cars available. Tourists are driving around in a U-Haul because that's the only option. Those are what I call transitory experiences that will go back to normal. We talked about a couple of these already. The U.S. economy, strong growth, but we're not quite back all the way to where we were before the pandemic. We've come a long way back, still have a little bit to go. Same thing goes with industrial production. So economy not quite back, industrial production not quite back, but company profits. Companies find a way to make money quickly, and they've done that. Earnings are back above where they were before the pandemic, which is huge for stock prices. So again, I won't go through this in too much detail. This is consumer confidence, consumer confidence board here. You see the big surge in confidence just so far this year, kind of lining up with that reopening of the economy. And I wouldn't be surprised if we get back to record levels in terms of confidence. The job numbers is the one I really wanted to mention. You mentioned jobs have not been coming back at the rate we kind of thought they would. But a couple of positives there. Look at the weekly initial jobless claims. So new people coming in for employment, that number continues to go down. So a lot of people are staying unemployed longer than we have expected, but it continues to go down. Temporary supply constraints of labor. So there's three factors that are really affecting jobs not coming back as fast as we want them to. One, extended unemployment benefits. The government's going to pay you $11, $12 to either stay at home or look for another job that may pay you $20 an hour. People are going to take that option over trying to find a $10 an hour job now. So what you're finding is less of people just staying at home and collecting benefits, more of them looking for the higher paying job and realizing they have no risk until September when those benefits expire. But already starting to see those benefits expire in some states. We have over 10 states where extended unemployment benefits are expiring. And I would expect those states to start magically having better job numbers as those people come back. But that's not the full story. If you say that's the full story, you're not looking at all the data. There's a couple other things constraining supply. This shows students enrolled by instructional mode. This was by the end of March. By the end of March across the country, only 44% of kids were back in school full time. 34 were remote, 21% were hybrid here. And that causes issues when it comes to childcare. I know there's many families. In fact, my own family is an example of that. My wife works part-time in a normal economy. In this economy where my son, he's back in school full-time, but he's only in school till 12:30 instead of the usual 3. So for us, it means my wife's going to probably go back to work at the start of next year instead of right now until the school schedule normalizes. And there's thousands in our situation where temporary unemployment because of childcare. Same thing goes with seniors. You have a lot of seniors that re-entered the workforce, not necessarily because they needed the money, but because pay was good before the pandemic, and part-time jobs and activities to do in retirement led to senior employment being high, and safety concerns really brought a lot of seniors out of the workforce. I mean, again, just in my family alone, I have 2 anecdotal evidence of this. I mean, my mom was a part-time substitute teacher. She's a retired teacher who just loves being in the classroom a couple of days a week. And when the pandemic hit, said, I'm not going to take any risks of trying to be a substitute teacher. Call me back in 2022 because I'll go back when there's no school mask requirements and it's not a hassle to be a substitute teacher again up in Seattle. So again, another data point of someone leaving the work and not coming back and taking a job. And, those things are going to normalize themselves in the second half of this year into next year. So last couple of things. I know I want to wrap up in the next couple of minutes and have time for questions, but I wanted to hit on the big one, which is the inflation question. And this is looking at autos specifically. Look at auto production versus sales. I mentioned this before. Production went very far down at the start of the recession, all the way to zero for safety precautions. And then production never really came back up, and you started to have semiconductor shortages, et cetera. Now you have a rising demand amid this reopening, a lot from rental car companies jumping in. This mismatch, I mean, it's simple economics. Go back to your economics 101 class. When demand goes up and supply goes down, price has to go up temporarily. And that's where you're seeing a lot of the temporary inflation. So do not equate the April CPI increase with government spending and Fed activities, because it's not what's causing it. It's temporary imbalances between supply and demand. You know, look at cars, look at lumber, look at oil prices and airlines and hotels that are all coming back from such low levels. That's the inflation we don't want to worry about right now. The inflation we want to worry about is the 5-year longer run inflation expectations, which have jumped. But look at how far they were down at the start of the pandemic. Inflation dropped off a cliff, and now it's coming back strong and actually at higher levels than we've been averaging over the last 20 years. But notice the number here. The 5-year inflation expectation is right around 2.5%. So that is not 4+%. That is not going back to the 70s, but it is higher inflation than we've seen over the last 20 years. We're expected to see higher inflation ahead. So how do we deal with that? So again, we don't want to react to the temporary inflation, but we really want to start thinking that we're going to have sustained 2 to 2.5% inflation for the next 5, maybe even 10 years. And that would have a dramatic effect on some conservative investments, a dramatic effect on cash in the bank. So it does warrant thinking about. And I do think this is the biggest downside to all the government spending, all the Fed activities, has been punishing savers and conservative investments. Because of the aggressive government actions, it's forced everyone to take more risk to get ahead of this sustained inflation. It's forced people into going to riskier asset classes. And if you don't, you have the potential to get hit by this inflation over longer periods of time. And you can see it with Treasury yields here. This is my final slide, and we'll go into questions. You know, look at what happened when interest rates, when the pandemic hit. And the government has aggressively been pushing interest rates down. Now you're getting, call it 1.6% on a 10-year Treasury where we sit today. So if we had averaged 2.5% inflation over the next 5 years, and Treasuries are paying, 1.6% for the next few years, even before taxes, that doesn't look good for conservative investments. That puts negative pressure on conservative investments. And you can see our kind of overall strategy here. Core fixed income, the traditional bonds and cash, we've taken down to our lowest level ever. Interest rates expected to be 1 to 2%. Our opportunities that we're looking for are in things like opportunistic fixed income, higher risk bonds and munis, dividend stocks that will be helped by the surge in the economy and the additional government spending, and actually give us some natural protection against inflation. So I'm going to stop for now. I know there's going to be some in. I'll have a few more things to mention, but Chad, I'm going to turn it back over to you, see if any questions have come in so far, and give my voice just a second of break after talking for a good portion straight.
Get a drink of water. I know it's a lot of talking on there. So, Robert, a lot of really good information there. Do you have that tax slide that we usually kind of talk about with all the upcoming proposals at least going on there? I'm going to let you bring that up if you wouldn't mind. And then we do have a question while you're bringing that up. And, how long do you think the supply chain issues are going to last? And I think that kind of leads to that next question is, if we know these are issues, what are going to be the ramifications once these supply chain issues are rectified?
Yeah, that's a good question. We'll hit on that one before going into the tax stuff. And, it kind of depends on each sector. So some are going to take longer than others to normalize. Some are going to be a lot quicker. Like the lumber question is probably going to be a few months because it's not easy for home builders and construction activity. Those are big industries to move, and some things are going to take months, and others are going to come back a little quicker. Like, I do think that the travel capacity and some of the autos will come back faster. And a question I get on the same topic is, should we be betting on commodities to participate in this surge of supply chain issues? And the answer to that is no. We've started to de-risk on some commodities because we're starting to see commodity prices level out. So we're already starting to see that, thankfully, like lumber prices are leveling out, copper prices leveling out. And we always think of the U.S. focus with a lot of this stuff, but many commodities are still really driven by China more than anyone else. And what happens in China drives commodity prices so much. And one of the things that's been happening in China is a lot of speculation on commodities. A lot of people buying up commodities, knowing these trends are there to, speculate on them. And the Chinese government does not like that, and they're cracking down on it as we speak. So that's a big risk out there. So I've gotten questions from clients. Okay, I want to buy some exposure to gold and copper and lithium and all these commodities that have been booming. You have big downside risks in this if China clamps down on speculation, no matter what happens in the U.S. So I think that's a big part of it, Chad.
Yeah, no, I totally agree. So this is one I know that I am getting a lot too, Robert. You and I talk about the taxes, and obviously there is a lot of unknowns. And I think I just wanted to kind of touch base. I know you did talk quite a bit about taxes during your presentation and some of the implications that are going to come. But I mean, as the slide shares here that I think is one of those really well done slides. It really talks about all the different between the American Jobs Plan and the American Family Plan, the possibilities for new money getting put into our system, but also how are we going to pay for that? And while there is obviously a lot on the table, Robert, part of our conversations, because I know we're going to get some questions on taxes, is that we just don't probably see all of these going through. We're already seeing the negotiations. Has there been any update from your guys' end as far as, likelihood of and how much you feel like, taxes could get raised? And do you see really much potential downside to any families who are making less than the $400,000 a year?
Yeah, good question. So I'll hit on a couple I didn't hit on yet. I mean, in the conversation we just had, I talked about corporate taxes. You see likely 25. So very low levels compared to a full reversal of the Trump tax cuts. We talked about corporate. One of the big ones that we get asked about is the capital gains rates. So that spooked people for a day when that was announced, saying that long-term capital gains will go away. But what many people didn't catch is that that's for those making $1 million or more a year. So there's likely to be no change in capital gains for those making under $1 million a year. It's only for those making more than $1 million a year. So we think that this is actually a likely one to go through. So if you're making more than $1 million a year, then I think this is something that could affect you in terms of gain planning. But I don't think it's something that's going to affect markets overall, because again, interest rates are so low. People aren't going to say, okay, my taxes on investing just went up. Now I'm going to buy 10-year treasuries at 1.5%. That's not going to happen. So don't think that the capital gains tax is going to have a market impact. And then, like you said, Chad, if you're making less than $400,000 a year, you're likely not to get hit by the marginal tax rate increase either. So personally, if you're making less than $400,000 a year and your estate overall is fairly low, you're likely not to see anything on the tax side of things. Now, again, the estate tax is something that could definitely be in play. I mean, the exemption right now, just over $11 million, is set to sunset in 2026. That could be accelerated. You got a couple different plans out there. You have a plan much more aggressive than the Biden kind of proposal. So again, I think something like what Biden's proposing with bringing the estate tax down, but not to the levels that Bernie's proposing, is likely. But again, I think a lot of it comes down to the planning side for those making a ton of money or have very high estates versus kind of your, traditional, again, 0.03% of the country or 0.3% of the country makes $1 million a year or more. So it's not going to affect a good portion of the people. Yeah. And we don't think it's going to be the final plan. If all of this stuff went through, market impact for sure. If of this go through, much more limited market impact. And I think the other thing you have to realize is that these tax increases are going with, or part of it is market positive. I mean, again, infrastructure spending, everyone I talk to in the construction business, like, yes, that's going to be good for business if we get, more funding for projects and that extra spending goes through. So good question.
Yeah.
An interesting presentation of what's on the table.
Well, you're sounding out for just a second there, but you're basically the key to that endpoint is that because all of these tax increases are going with the more spending by the federal government, is that is a very good sign. So as far as what we're looking at is, where we invest, how we invest, that even though we may have we will have tax increases, I'm pretty confident that we're going to see some tax increases. One, it's probably not going to affect 99% of the people based on having an income of less than $400,000, or for capital gains purposes, $1 million. So this is a question that I'm getting quite a bit, and I just wanted to make sure we touch base on this. So that's wonderful. Thank you, Robert, for that. If you want to close that down, I can just have a few more questions we can kind of answer as we're going. We have a couple of questions on housing markets. So one is, how are you guys forecasting housing prices? Because obviously they are accelerating very quickly in many parts of the country. So this is, I will tell you, I've probably had more people reaching out to me to talk about how they can purchase a house in this last 4 or 5 months than I had in the previous 5 years combined. So there is obviously an overlying demand right now, and I think there's a pressure, and people are saying, do we wait? Do we feel like prices will come back down? What's your guys' opinions on that?
Yeah, it's a fantastic question, because the housing market is not normal right now. It's this crazy experience where we don't have any supply of homes, and the demand is going up because interest rates are so low. So mortgage rates are low. You can buy a good house. And we just talked about, average net worths at a record level. So people are in great ability to buy homes. Not only individuals looking for homes, but investors. Interest rates are low. So, investors are out there looking for these homes too, not just individuals. So you have this just surge in demand, no supply. And we looked at the building permits. The building permits are very high, but the construction costs just jumped with all these supply chain issues and costs. So all the home builders are saying, hey, we got a bunch of projects in progress, but no more are starting for now, because, Toll Brothers came out and said, hey, the price of lumber is so high, we're going to wait a little bit to start some new projects until things normalize and we can get better prices. So, that indicates that, it's probably going to be an environment with low inventory for a long time, call it the next couple of years before that normalizes. So it's not a bubble like a 2007 where you're going to see this crash in market prices, but certainly you expect the market to down a little bit now. I mean, Phoenix, Scottsdale area is up 20% year over year. And that's the hottest, that's probably the number one right now area. And just the speculation is off the charts there. You have people, buying homes with sight unseen, all cash, waiving inspections, all that type of stuff is a sign of a little bit of frothiness in the market. So I think the biggest risk to home prices is actually interest rates going up, because the second interest rates go up, that's when those mortgages now are not out there at the same rates. That's when people's buying power goes down significantly, and that's what's going to get people out of the market for homes. But we don't see it being a big crash, just more of a normalization. So if you're out there like speculating on homes, trying to pick one up for investments, I think it's time to, be careful. You probably get maybe a better buying opportunity. But if you're like, if you need to move and you want to live in a different place, it's probably fine to go out and make it happen, because that low inventory environment, low interest rate environment could persist for a while.
Yeah, I think that's very similar to what we're telling our clients as well, is that if it's for your home and where you're going to live and it's not an investment, we're going to be dealing with, you might have house appreciation, but you also have low interest rates. But eventually when the interest rates go up, that might be what slows down the house prices increases, but then you're going to be paying more to the mortgage versus the house prices. So if it's for a house you're living in, we're still suggesting, if you want to buy and you can, this is, you have to live somewhere. So, but it is difficult. I mean, it's great when you have the appreciation, but then when if you want to buy, you're hating it, but you're loving the selling part of it. So, all right, well, good. Thank you. 2 more questions before we get going here. What do you see in the labor markets for highly skilled college educated workers? Potential for limiting some industry growth, especially high tech. So I think
well, I'm glad this question got asked, because it's a fantastic one, and one we have a lot of data on. I didn't have time to put this chart in the presentation, but we looked at the job market and said, hey, we have 30% to go to get back to where we were. We still have close to 7 million jobs to create to get back to where we were before the pandemic. But almost all of those jobs are middle and low income jobs. Mm-hmm. The high income, high skilled jobs not only are all the way back, but they're higher than they were before the pandemic. The demand is super high for those jobs. And definitely, like in terms of the question, there is a lack of workers to take those jobs. I mean, look at pretty much every one of the tech companies has been continuously hiring for a decade. I mean, with so many open jobs, hundreds of jobs at Amazon and Google and Microsoft and Amazon. So there definitely is a disconnect between the labor out there and the demand, at least in the high income jobs. Now, the low income jobs are the ones that are most affected by those extended benefits. So when those benefits go away, that could bring back a lot of the lower income jobs. But anything that can be done to match more workers with the skills that are desired is certainly going to boost the economy, because it definitely limits growth. I mean, the tech companies, tell you that right away with their hiring lists. I mean, if they had the right amount of people, if they didn't think there were opportunities, they wouldn't have 100 jobs posted at all times. So, there is no shortage of demand for high skilled engineers and PhDs and all sorts of stuff, even for companies like ours in the financial world. I mean, when you have our company has very high qualifications for hiring. We require a master's in finance and a chartered financial analyst designation. And, sometimes we have job openings that no one fits the criteria. And you say, hey, we wish some more people were out there trying to get some of these high skilled designations. And, they're just not always out there. So, again, when it comes to, I know it's always a hot topic when it comes to immigration and skilled worker visas. But the data shows that, again, we're a very data-focused firm. So the data shows that if you can increase those worker visas, you're not necessarily cannibalizing American jobs. There's so many of those jobs available and not enough people to take those jobs. So if you can bring over, 10 talented engineers from India and 10 from Russia and 10 from China, that's given the economy a lot of bang for your buck, because those jobs were open to begin with, and that's going to help the growth rate. So you can do either by education of people who are looking for work to upgrade their jobs, or by importing them in, that really helps the growth. This is single-handedly one of the biggest issues with Japan. Japan has almost zero immigration. They're not importing any talent. They're starting to do this a little bit, but it gives an economy a huge advantage when you can build your labor force through skilled employees coming from outside the border. So hopefully it's something that we do see go forward, but definitely something that holds back, growth, even in good times for technology and high skilled companies.
Thank you. One question, we have a question about China, which obviously was a much bigger question here. That was always a concern of, when there's issues with the China and US and the trade war and all the tariffs. Kind of coming back to it is obviously, it seems like a lot of the conversation about China, the tariffs, everything is kind of falling off a little bit, but it does seem like we are starting to see some headlines with, China exerting a little bit more, possibly manipulation, if you want to use that word. And what is the U.S. Doing, and what's the rest of the world doing, or do you see anything that is a concern as far as how that affects the markets?
Well, yeah, you can see it on the page here. Geopolitical risk is, it's not red, but it's one of the most negative indicators here on the speedometer page. And I'd say 95% of the geopolitical risk right now is the U.S. and China dynamics, because it's everything. The relationship is tense, and China is the second biggest economy in the world. We talked about in terms of commodities. China really drives the commodity prices. We think the U.S. does, and U.S. has an impact, but China does drive the commodity prices. And one of the questions that came in was, China has a lot of the rare earth metals, and a lot of the technology needs those metals. And that's certainly going to be a very tricky subject in the future. If China decides to cut off those supplies, where else can you go to get some of those? Can they, manipulate the prices there? Big concern. I actually don't know the answer to how that plays out. But I do know that U.S. companies and U.S. government is scouring the earth for those rare earth metals. Any you can find outside of China is a preferred solution to having to rely on China for inputs. So that relationship is going to be tense. You have very unsettling dynamics between Taiwan and China, where Taiwan has been thriving and becoming a bigger part of global technology supply chains, and Taiwan Semiconductor being one of the biggest, strongest, and most valuable companies in the world, certainly doesn't. China doesn't like that, especially as the U.S. is developing, more and more ties with Taiwan, and big headlines in the news. It's this it's walking a thin line between trying to keep relations just good enough with China to make sure everything doesn't blow up, but at the same time putting pressure on them for certain things that they are a bad actor on. They do not play a fair game, and haven't for a while. So we'll see what happens there, but this is going to be a 50-year story, how these two world superpowers coexist and where we go from here.
Hey, Robert, thank you so much for your time and all the energy you did put into these slides and answering questions for our clients. I really appreciate it. You're always a great resource. I know we talk a lot, and I think this is just really helpful. I'm going to put out there, if any of you have more questions, you want to email me or any of our team, you are more than welcome to. Thank you for taking the time. This will be recorded. If you did want to watch it, you'll get an email with the link to the recording. But oh, yep.
I've got one more, Shad. One
yes.
more. Again, I think this is one that I'm getting asked in every meeting, so I want to make sure to hit one more for the road to leave everybody with. Right. I've been asked for ideas on gold and gold prices, and thinking about inflation hedges. People are saying, oh, gold and cryptocurrencies are that's the inflation hedge. Just get money into precious metals and cryptocurrencies. And if you've been following the price of gold, at a time when inflation has been spiking, gold is negative year to date. Gold has not seen a surge in activity. If you've been following cryptocurrencies, hopefully you haven't bought any recently, because they're down about 50%, or at one point we're down 50% from the highs. So it's an important reminder that gold and cryptocurrencies sometimes can act as inflation hedges, but not always. They can move different inflation. To me, one of the inflation hedges is exposure to highly profitable companies. And when you have exposure to highly profitable companies, what happens when inflation goes up? Companies are raising prices. Look at the supply and demand issues. The companies that are selling this stuff raise their prices and sell it. They're not affected from a profitability standpoint. Maybe they'd be making more money if prices were lower when supply picks up, but you're getting that natural hedge when you're invested in stocks. So it's one of our big reasons for being out of the traditional bonds or low in the traditional bonds, higher in profitable companies. And we actually are not investing in gold right now, not investing in commodities, not investing in cryptocurrencies. And I think this year has been a great example as to why that is. So predicting the price of gold is notoriously impossible. At times like this, you'd think it'd be surging. You'd think gold prices would be going up with inflation picking up, and they haven't. But all in all, at the end of the day, gold doesn't pay you a dividend. Gold doesn't have any profitability. Gold is all about what everyone else thinks it's worth. And at the end of the day, that makes it notoriously tough to figure out what the price is. Yep. When it comes to a company stock, hey, I know how much this company is likely to make. I know where interest rates are. I have a general idea of how much this company should be worth. That's where we direct a lot of energy. So hopefully that was a good closing, Chad. Sorry to cut you off, but again, thank everyone for their time today. It's been a lot of fun going through this.
Oh, awesome. That was a great one. I'm glad you brought that up. That is one of the top questions that we're getting as well at this time. And it's a very similar answer. So no, I think that was perfect. I think a lot of our clients can see why we work with you with quite a few of them. So thank you again. And like I said, if any of you have questions and you want to follow up, please feel free. Have a wonderful afternoon or day or night or whatever time it is for you when you watch. Take care.